Hey everyone, I recently came across a very interesting report by DAM Capital titled Potential 3-Year Doublers, where it has shared 11 stock names that can potentially double in next 3 years. The logic behind selecting these 11 stocks is based on the fact that these stocks can witness their EBITDA doubling in the next 3 years and not offset by any significant derating after 3 years. Out of these 11 names, 5 stocks we have already discussed in the past. Okay, before we proceed, just a disclaimer, it is not a buy or sell call. Please do your own research before investing your money. Alright, let's not waste any time and get started with the list. So first stock is KEC International. KEC is the flagship company of RPG Group that was established in 1945. So it's an 80-year-old company. It is a leading provider of end-to-end turnkey services for projects in your transmission and distribution, then railway sector and solar power segment. It also provides engineering, procurement and construction services for civil work. The key reason for its potential 2x growth in the next 3 years is due to sharp uptick in the government capex. Indian government has strong focus on renewable energy generation and there is a strong domestic tender pipeline for your transmission and distribution, also known as T&D. Then civil is another growth area for the company due to water projects, metro, industrial, then data center, urban infra with a strong backlog of 10,500 crore as of Q1 of FY24. KEC is also expanding its capability in this segment. Likewise, there is a huge growth in railway investment in the areas like ABS, that's your automatic block signaling, then speed upgradation, then OHE, that is overhead signaling, and so on. Overall, there is a tender pipeline of 1.1 lakh crore, out of which KEC has already bid for 30,000 crore of order and further bids are submitted for 80,000 crore worth of order. Management is expecting to grow inflows at 15% CAGR. As per report, KEC revenue is expected to grow from 17,200 crore in FY23 to 23,600 crore. This data is in billion rupee and we are talking in terms of crore. PAT is expected to grow from 180 crore to 1000 crore and EPS is expected to grow from 6.8 to 39.3. Now on quick look on screener, you will first notice that company's PE is significantly high. It's because there is a sharp fall in company's operating margin from 11% during pre-COVID level to 5%. That has badly impacted company's profit and hence PE ratio. However, management is confident of improving margin due to first, SAE losses behind with completion of all EPC project. Basically, company's Brazil subsidiary SAE reported losses in the past that impacted its margin. However, now the EPC projects are completed, so losses are behind. This will boost company's profitability in the future. Then second factor is lower raw material cost and third is execution of high margin orders. Management aspire to take margins back to double digit in the next 2-3 years and that is the reason eventually its PE ratio will fall significantly. In terms of price to sale, companies reported trailing 12-month sale of 18,000 crore and company has a market cap of around 17,000 crore. So price to sale is less than 1. In terms of risk, raw material volatility and slowdown in T&D projects are key risks. Now second stock in the list is Tata Trent. Trent is India's leading retailer with brands like Westside, Zudio, then Star and a joint venture with global power brand Zara. The current store count for Westside and Zudio stand at 221 and 388 exclusive brand outlet respectively and company is growing at a fast rate. If you recall, I did an in-depth video on Trent a few months ago and at that time it was trading at around 1350 with a market cap of around 48,000 crore. Even during that time it used to command a PE of 147 but I clearly explained the reason why you should not look at its PE. A lot of people don't understand how to gauge company's valuation. They simply look at PE and if the PE is high, they reject it. Fast forward today, Tata Trent is trading at more than 2,000 rupee with a market cap of nearly 72,000 crore. That's more than 50% return since the day I did the video. If you haven't watched it, do have a look. In fact, I keep discussing great stocks and reviews their quarterly performance in my weekly video series published on my website where I also share my portfolio detail. In this series, I also continue to discuss potential sectors and stock that generate great return. It's a great community of serious investors that I have built over the time. In case you are interested, I provided the details in the pinned comment. Yes, Trent PE is still showing very high at 162, but in spite of that, it can be a potential doubler in the next 3 years. The rationale is that after 15 years of learning since the launch of its brand, Trent has cracked the right store economics and the payback has already started in last 18 months at store level ROC of 40%. Best part is nearly 99% of company's portfolio is owned by the company. So they sell their own brand, and that's where there is high margin. Both its brand Westside and Zudio have got high growth potential. Especially Zudio has been cashing on the time Trent has spent perfecting its Westside model. It works at 2/3 the gross margin of Westside, with its standalone store clocking 40% higher throughout than Westside. Then Zudio stores are expected to grow from current levels of 388 to a count of 900 by FY26. As per DAM report, company's revenue is expected to grow from 7,720 crore in FY23 to 14,200 crore. PAT is expected to grow from 550 crore in FY23 to 1250 crore, and EPS is expected to grow from 15.6 to 35.2. Then third stock in the list is Escorts Kubota. It is the fourth largest tractor OEM in India with around 10% market share. Company operates under three segments: agri machinery, construction equipment, and railway equipment, where agri machinery segment has around 80% revenue contribution. As per report, the key reason for company's high growth potential is due to high synergy with its partner Kubota, which is more than 130-year-old Japanese company. In last few years, Kubota has made significant investment in Escort and raised its stake to currently at 53.5%. So this synergy between Escort and Kubota will result in high growth for Escort Kubota in the coming year. There is a new management after Kubota has acquired majority stake and has already done operational restructuring and taken various cost saving initiatives. Basically, Escort Kubota is expected to hugely benefit from global network of Kubota over the next decade. Company is expected to expand its margin, post healthy cash flow and strong return ratio. As per report, company's revenue is expected to grow from 8,340 crore in FY23 to 10,890 crore. PAT is expected to grow from 680 crore to 1,410 crore, and EPS is expected to grow from 61.6 to 126. Currently, company is trading at a market cap of around 42,000 crore with a PE ratio of 52. Potential risk for Escort Kubota thesis could be prolonged slowdown in rural economy, increase in commodity prices, and geopolitical issues restricting exports. Fourth stock in the list is Bharat Forge. It is one of the largest steel forging company in the world in terms of capacity and revenue, with presence in automotive as well as non-automotive component sector, including highly critical engineering components. If you recall, I've already done an in-depth video on Bharat Forge last year when it was trading at around 747, and currently the share is trading at more than 1,000 rupee. Stock price consolidated for almost 8-9 months, but now stock has already generated more than 40% return. In the video, I clearly explained why I'm bullish on this company. The key reason is strong traction across defense, energy, aerospace, railway and locomotives. Especially government is focused on indigenization of defense sector, where there is huge growth potential for Bharat Forge over the next decade. Bharat Forge would emerge as a key engineering and defense player and would command a premium valuation. So it is still worth considering for potential double return in the next 3 years. As per report, company's revenue is expected to grow from 12,910 crore in FY23 to 18,140 crore by FY25. PAT is expected to grow from 630 crore to 1670 crore, and EPS is expected to grow from 13.5 to 35.9. Currently, company is trading at a market cap of around 50,000 crore with a PE ratio of 85. Potential risk for Bharat Forge thesis could be increase in commodity price, slower than expected ramp up in non-auto segment, and earlier than expected cyclical reversal of commercial vehicle segment. Now, fifth stock in the list is Astral. Astral is one of the fastest growing pipe brands in India and is one of the pioneer in the CPVC space. Company is now molding itself into a one-stop shop for home improvement products, where it is entering into water tank, bathware, adhesive and paint space. Although Astral is currently trading at a very high PE of 106, but it is still looking promising for the next many years due to its significant addressable market across pipes, then your paints, adhesive and bathware segment. Company has already proved its leadership in the piping segment and now it has an opportunity to expand into other segments like your paint, adhesive, bathware. That has huge addressable market to fuel the growth for many years. Second reason is it has got extraordinary leadership with clean corporate governance. And third reason is its proven ground level execution capability. As per report, company's revenue is expected to grow from 5,160 crore in FY23 to 7,910 crore by FY25. PAT is expected to grow from 480 crore to 1,000 crore, and EPS is expected to grow from 17.9 to 37.3. Currently, company is trading at a market cap of around 50,000 crore. If you recall, I did a video on piping sector a few months ago when all the piping sectors were down. I explained the reason for correction and also mentioned that it is a great time to add these piping stocks. Just check the performance now. All of them have outperformed. Now, potential risk for Astral thesis could be your high working capital for paint and bathware segment and the new product category is not scaled yet. Sixth stock in the list is TVS Motor. This flagship company of TVS Group is the third largest two-wheeler manufacturer in India. The key trigger for its potential doubling in next 3 years include strong outperformance expectation in domestic as well as export market, owing to better product, improved brand equity and premiumization trend that would also act as the biggest catalyst for earning upgrade and further re-rating. TVS has already emerged as the second largest electric vehicle player. It is better prepared for EV transition and likely to witness a potential value unlocking from the EV business. As per report, company's revenue is expected to grow from 26,380 crore in FY23 to 37,300 crore by FY25. PAT is expected to grow from 1,440 crore to 2,890 crore and EPS is expected to grow from 30.4 to 60.9. Currently, company is trading at a market cap of around 71,000 crore. Now, a few risks in this thesis could be slower than expected revival of domestic as well as export market, failure in new product launches, and sharp rise in commodity prices. Seventh stock in the list is IDFC First Bank. If you are following my channel, you would know that I have discussed it multiple times in the past since IDFC was trading below the levels of 50 and today IDFC is trading in the 90s. This report from DAM Capital is expecting IDFC First to even potentially double from current levels in the next 3 years. The biggest reason for IDFC First expected outperformance is its strong retail franchisee with 77% retail deposit and 70% of loans to consumer and retail with 46.5% CASA ratio. Mind you, 5 years ago, bank had more than 70% deposit from wholesale segment and now it's 75% retail oriented deposit franchisee. It's an extraordinary transition under the leadership of Mr. Vaidyanathan, where IDFC First has now overcome majority of legacy issue and now the bank is scaling quickly and has witnessed an improved return ratio profile with ROA at 1.3% and ROE at 12%. These metrics are expected to further improve towards 1.35% and 13.5% respectively by FY25 on the back of strong growth in retail loans, granular liability franchisee, then tailwind from favorable asset quality cycle. Bank's issue has been the operating cost metric and now with substantial investment in place, bank is on strong foundation to see emergence of scale and operating efficiency. This will lead to better cost to income of below 70% by FY25 and operating profit growth of 30% CAGR over FY24 to 26. Bank's gross NPA is also expected to reduce to around 1.6 to 1.7% and net NPA is expected to reduce to around 0.5 to 0.6% over FY24 to 25. As per report, bank's net interest income is expected to grow from 12,640 crore in FY23 to 19,490 crore by FY25. PAT is expected to grow from 2,440 crore to 4,110 crore and EPS is expected to grow from 3.8 to 6.2. Currently, bank is trading at a market cap of around 62,000 crore with a price to book of 2.35. Then eighth stock in the list is Indiamart International. Indiamart is the first and the largest B2B digital marketplace in the country with nearly 70% share. It focuses on integrating small and medium businesses into the online marketplace. As per report, the key factor for growth in Indiamart International is due to huge untapped market that is expected to grow at 25% CAGR rate over the next 5 years. Then second factor is there are 6.7 million MSME in India. Even if around 10% of them join Indiamart, it has 4 times growth opportunity from current base. Company has negative working capital, very low capex requirement that result in high cash conversion. In last 3 years, company has generated free cash flow of 1,177 crore. As per report, company's revenue is expected to grow from 990 crore in FY23 to 1460 crore and PAT is expected to grow from 280 crore to 460 crore and EPS is expected to grow from 46.5 to 75.6. Currently, company is trading at a market cap of around 17,500 crore with a price to earning of 58. I've already done in-depth analysis on Indiamart International. Then ninth stock in the list is Havells India, a leading electrical goods company with a portfolio of switchgear, cables, lighting fixtures, then electric consumer division that include your fan, appliances, water heater, then Lloyd brand for AC, then television, washing machine, refrigerator, and other products like your motor, solar, pump, water purifier, and personal grooming products. Havells has a total of 21 product verticals spread across a total addressable market of 1.2 lakh crore rupees. Hence, it is well positioned to capture the consumption story of India. Going forward, the big growth driver for the company include your real estate upcycle and increase in capex and export for cables and switchgear. Havells is leveraging on trends like premiumization, digitization, and catering to changing consumer need and increasing its penetration. As per report, company's revenues is expected to grow from 16,910 crore in FY23 to 22,120 crore. PAT is expected to grow from 1,070 crore in FY23 to 1,940 crore, and EPS is expected to grow from 17.1 to 31. Currently, company is trading at a market cap of around 88,000 crore with a price to earning of 79. 10th stock in the list is Minda. Again, we have already discussed this company in the past. Minda is among the top auxiliary players in the country with presence across product line of lighting, switches, acoustic, then casting, alloy wheel, then seat sensor, blow molding, PCBs, then air filters, airbags, and EV components. Now there are two key triggers for Minda outperformance in the coming year. First is premiumization theme. There's a big trend of premiumization in auto industry where consumers are preferring better features in the car. This trend would also result in improvement in company's margin. Second is electric vehicle. Minda is focused on electric vehicle specific products with revenue target of around 1500 crore from electric vehicle over the next 2-3 years. As per report, company's revenue is expected to grow from 11,200 crore in FY23 to 16,210 crore by FY25. PAT is expected to grow from 650 crore to 1240 crore, and EPS is expected to grow from 11.4 to 21.7. Currently, company is trading at a market cap of around 34,000 crore with a PE ratio of 49. Few risks in this thesis could be slower than expected growth in auto demand, pricing pressure from OEMs, and sharp rise in commodity prices. Now, final stock in the list is Mahindra & Mahindra Financial Service. It's an NBFC primarily engaged in the business of financing purchase of new and pre-owned auto and utility vehicle, then tractors, cars, commercial vehicle, construction equipment, and your SME financing. The key growth lever for the company is the aspirational management target to double its book by FY25 that would result in 25 to 26% CAGR growth. Since the auto sector is now in good shape, that constitute around 44% of company's business, the targets looks achievable. There is also a commendable improvement in asset quality with consistent fall in NPA from peak of 7.8% to 1.7%. As per report, company's ROE is expected to touch 18 to 20% mark by FY26-27, and book value is expected to increase from current level of 150 to 250 by FY28. Company's current book price to book is 1.9 and trading at around 290 rupee with a market cap of around 35,000 crore. Expecting price to book of 2.4 to 2.5 times, Mahindra & Mahindra Financial Service share price is expected to touch around 600 rupee in the next 3 years. So in this video, we discussed the research report by DAM Capital where it covered 11 stocks that can potentially double in the next 3 years. If I quickly summarize, it includes KEC International, Tata Trent, Escorts Kubota, Bharat Forge, Astral, TVS Motor, IDFC First Bank, Indiamart International, Havells India, Minda, and Mahindra & Mahindra Financial Services. Out of this list, we have already discussed 5 stocks in the past. In case you want to go through those videos, I have provided the link in the description. Now tell me in the comments, which stock do you hold from this list? If you find this video useful, do share it with your friends. I'll see you next video. Till then, take care.